Well, clearly gold was never really a safe haven status in the way that the markets had portrayed. Investors that had bought gold years back bought so then. The trade more recently has been very crowded. It's been more trading, more speculative orientated. It's fast money. The China data was interesting data. That was really the trigger for the sell-off. And look, people just don't want to use gold in the way it's traditionally been used. It's being used now as a provider of liquidity. Things go wrong, people sell their gold and then they use the cash proceeds to invest elsewhere. That can be a negative scenario or a positive scenario.
What do you think, Marcus? Does that sound right to you, that it never really had a safe haven status?
No, not at all. I think just because some speculative traders are washed out in a big futures trade in New York over the weekend, that doesn't change 6,000 years of history and hundreds of years of gold as both a liquidity source, a source of insurance and a source of a safe haven in bad times. I think all of those things are still true about gold. I think this particular correction has been engineered by one particular large transaction that went through about $20 billion over the weekend, 400-ton short position in the futures market. A lot of the investors I talk to still see a very fragile economic recovery. They still see gold as an essential asset to have to protect wealth.
What do you think, Yogi? Is this simply a market correction on a market that was frothy, or a long-term downward trend? Because let's face it, the spectre of inflation has not disappeared, has it?
No, it hasn't. And look, QE's coming to an end as well. I think what Marcus is saying, there is some merit to.
You say that, hang on a minute, not in Japan. In Japan, they're printing money like billio.
Sure, that's in Japan, but I think this particular event is more to do with individuals, investors needing liquidity very quickly. There are a lot of people that are structurally very long gold, and they're quite worried about the sell-off that they've seen. The likes of Paulson out there will be struggling. A lot of private investors will be struggling. I think we're about 2/3 of the way through the correction. And as for gold as a safe haven, well, look what happened when the US got downgraded. Really bad news, and gold actually sold off. It sold off because gold is being used as a cash alternative, not as a safe haven trade.
And why do people need cash so suddenly?
I think they've got obligations to meet on the negative side if they have been long gold. They've now seen it sell off and there are problems there. But even on the positive side, if you're more optimistic, the global markets as we are in the second half of the year, investors will be selling gold and reallocating to riskier assets. They'll be doing the same with the Swiss franc, and they've already started doing the same with the Japanese yen.
That makes sense, doesn't it, Marcus? People, rightly or wrongly, do seem to be more optimistic, and if you're more optimistic, you're less likely to find gold and that safe haven status attractive.
I think there is some truth in that sentiment has improved in the first quarter of this year, and we have seen some rotation back into equities. A number of funds have shifted from bonds and cash, and to some degree from precious metals, into developed equity markets predominantly. But I think this is an investment that it has to be handled with care. The economic recovery in the United States is still fragile. The most recent figures were worse than expected. We expect QE to continue a lot longer, well into next year. We don't believe it will end this year. And then, as you said earlier about Japan, I mean, they are now trying what's being called emergency quantitative easing in order to try and end 20 years of deflation. Now, of course, in the short run, that will give a boost to equities, put some pressure on gold. But at the end of the day, I think a lot of investors question, other than some short-term profits, how successful will that Japanese policy be? The bigger worry I have is if you look at commodity prices, those that are used in economic activity, they're all going down at the moment. So I don't understand what's happening here. The fundamentals would say you should get more positive about the economy, yet commodity-sensitive, economically sensitive commodities are coming down in price. Now, I don't think that's just on the back of some slightly weaker numbers in China. They're still growing around 7.5%. Retail sales were still up 12%, 24% increase in fixed investment. I actually thought the figures from China weren't that bad at all. They were pretty good.
All right, let's put that to Yogi. Setting aside the financial issues and the economic issues, what about the sort of geopolitical issues, the military issues? Iran is warmongering, North Korea is warmongering, Afghanistan is unresolved. there's plenty of reasons out there for us to feel nervous.
Absolutely, and if you do feel nervous, the right asset class to go into is short-term government bonds rather than gold, which is in bubble territory. What I think investors need to do is just apply some common sense to what's actually going on with gold. In the 1990s, gold was at $400 a troy ounce. In 1999, it hit a low point of $251 a troy ounce.
Just the point at which Gordon Brown sold the lot and told the market he was going to do it.
Exactly. So to be up at $1,800 a troy ounce is just absolutely absurd. It's clearly in a bubble. It was due a correction. You've had a trigger event that allowed the correction to take place. Investors are just going to reallocate. They need liquidity at the moment. That's the reason for the sell-off. In a more buoyant market, they will just reallocate to riskier assets, which will include global equities.
If Yogi is right, Marcus, this price is not going to bottom out at $1,400, is it? It's not going to bottom out at $1,000. We've got a long way to plunge.
Well, I think if that thesis is right, we are, after 5 years of readjustment, we've put the worst economic cycle behind us since the 1930s. We've avoided another depression. The debt levels sitting behind most large economies in the OECD don't matter, won't have an effect on economic growth. And equities in that case are off to the races. And eventually you might get some inflation come back into the system, and then gold, I would contend gold would then do very well in that scenario. I mean, the first problem I have is I don't believe that scenario. I think this recovery is extremely fragile in the United States, let alone here in the UK or in Europe. The Eurozone still has many issues to resolve before it gets back to normalcy and the debt levels start to come down, which are a huge drag on growth. Of course, in the long run, equities have been an excellent investment. You will always have a positive risk premium to human enterprise and economic growth and productivity. But I don't think that in any way invalidates having gold in a portfolio when you're in a cycle that's being turned through a massive experiment in quantitative easing around the world, the like of which we have never seen before, which is debasing currencies. It will ultimately be likely to cause inflation. It's causing currencies to depreciate in general, or has done over the last 10 years
Marcus,
against gold.
Can I just interrupt you, because we're running out of time, and that's an important point. The debasing of currencies has not stopped, has it?
No, it hasn't.
We have signals coming from this country that Mark Carney will try almost anything to find a way to make sterling more attractive and force down the price of sterling.
Completely. I mean, currency wars are a big part of what's going on in the marketplace at the moment. You've seen it in the UK, you've seen it in Japan as well. That will continue for some time. Perhaps the right way to look at gold is a currency without a home, and you will continue to see downward pressure on gold as well. I actually am more optimistic than Marcus in the way that the world is going to play out over the longer term. I think at the end of the day, share prices appreciate based on corporate profits, not on geopolitical events. And the Q2 earnings numbers that we are having are going to be absolutely key in this environment. It's not about cost cutting, it's about revenue growth, and it's about guidance. And if those signs are there, we see a stronger H2 and things improving into 2014. That is not great news for gold, which is already beaten up.
All right, Yogi Dewan and Marcus Grubb, many thanks for joining us. We appreciate your time.